and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of The Tie. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Hello and welcome to Fundamental Value, a journey to quantify crypto. I'm your host, Joshua Frank, co-founder and CEO of The Tie. Today, I'm super excited to be joined by Brian Crain, co-founder and CEO of Chorus One. Brian, it's great to have you on.
Thanks so much for having me. It's a pleasure to join you.
And so can we start, you've been in the crypto space for a while, but where were you before? What's your background and what drew you into the space?
Yeah, so I'm from Switzerland originally. I got kind of interested in economics when I was a teenager. So I went to college in Chicago at the University of Chicago and studied economics there. And afterwards was sort of like trying to figure out what to do. We got interested in startups a bit in technology. So I was like working on a startup in maybe 2010 and that failed. And then I was doing a master's degree after that. And sort of as I was finishing my master's degree in 2013, I learned about Bitcoin. And for me, Bitcoin kind of brought together a few of the interests I had. One which was technology, another one was economics, game theory. I also was just really excited about this idea of having a financial system that's beyond sort of the control of a particular nation state, the regulators of a government, and the possibilities that can unleash in terms of freedom and innovation and progress. So I learned about Bitcoin then, and since then I've been working in the crypto space. So I haven't really had much of a career outside of crypto. I mean, I once spent like a summer in New York working for an investment bank as an intern, and had this kind of failed startup. But it's basically been all crypto for me.
Yeah, and I think a lot of people within this space are actually in a similar boat, myself included. I started The Tie, about 9 months out of graduating college. So been rolling for about 5 years since then, as we were discussing before. But Chorus One isn't your first foray into crypto. So while crypto is your first real career experience, Chorus One isn't your first real role within crypto. You actually were chief operating officer of Tendermint, and anyone who doesn't know, that's really the firm that was behind the launch of Cosmos. So you were there in its earliest days, as part of its inception. So can you share what that was kind of like? I believe you guys, when was your ICO? It was early 2017, right? So
yeah.
Kind of what that was like, what the fundraising experience was like at that time. And obviously you were there during the first, absolute mania of digital assets being the 2017 bull market.
Yeah. I mean, I had joined a company called Ares Industries that later kind of renamed to Monax in 2015. And they were trying to do enterprise smart contract applications, for banks and enterprise customers. And they had forked Ethereum. And then they were like, okay, we should have some kind of different consensus because mining doesn't make sense. So what can we use? And then they kind of looked around and saw, is there anything? And the one thing that there was this thing called Tendermint. And Tendermint at the time was, like one guy and a white paper and a bit of code. And in this company that I was working at, they had raised some venture capital money. They had, a bit of a team. They were a better resource than this guy. So Jay Kwon, who's the founder of Tendermint. So, that company, Ares, started to contribute to Tendermint and working on it. So this was in my previous company already that I was kind of connected with Tendermint before there was really any proof of stake chains that were live. And, so I was working in this enterprise blockchain space for 2015, end of 2016. And I just felt it wasn't really moving because the issue is with all of these enterprise blockchain use cases, you have all of these different companies and they have to come to agreement to do something, and they're all big and political and slow. and they have to all coordinate, and it just doesn't work. So that was my experience then. And but then there was Tendermint, and they had decided, and so just for people who are not aware, Tendermint is basically the kind of consensus engine. So it's the thing that the kind of technology that allows the different participants come to consensus about, what are the blocks, and verify the blocks and create valid blocks, and kind of provides the security for a blockchain, for a proof of stake blockchain. So so I joined those guys then. There was like 4 people at the time. There was not much of an organization, and it was a bit of a chaotic thing. And then we were like, okay, we're going to do this token sale, this fundraiser in, I think, April 2017. And we built everything ourselves, the technology, right? So for people to donate Bitcoin or Ether and tend to generate the key and keep the key. So there was actually quite a lot of like technical development that was going into that. Because it was not the ERC20 or something like that, right? It was to launch your own blockchain. So it was more complicated than just the kind of ERC20 token sale on Ethereum. And it honestly was very hard to know, are people actually going to be interested? Is this token fundraiser going to succeed? At the time, there had been hardly any, ICOs. And, I was more also doing a little bit of this community engagement, answering questions, doing some interview, events and things like that. But then in the end, it's just people did come, right? Because there was enough people who had heard about it and who were very interested in it. And we ended up raising 17 million in like half an hour. And then basically this was a cap, and then it was closed down. And it was very surprising, like how fast it went. We were all kind of like shocked. And this was the biggest fundraiser at the time in such a short time. It was, I think, slightly bigger than Ethereum. And, in Ethereum had taken like 2 months to raise it. And we took like 30 minutes. But then, of course, within a month, you started having all kinds of it was really just at the beginning of this token sale ICO mania, when you had for the people who weren't there, you had crazy projects raising insane amounts of money in no time, and there was this rush to get into everything, and we were just at the cusp of that starting.
I mean, it's really amazing when you look back. I mean, I don't know if you remember, I was reminiscing about a token called Tata 2. I don't know if you remember this, but they were trying to build a decentralized Netflix. They did an ICO in 2017 and raised $500 million, and no one's talking about them. They have nothing, no product, nothing. And they're not the only one. I mean, there are a number of projects that raised 30, 50, 100, multiple hundreds of millions of dollars. And like, you look at any other venture market, and there was nothing that matched that, right? I mean, EOS raising $4 billion pre-product, right? Like, it really became quite a wild time. But since that time, Cosmos has actually built a tremendous amount and has a tremendous amount of builders building on top of them. So obviously credit to the team. And so while you've left Tendermint full time to start Chorus One, I believe you continue to work with the Interchain Foundation. So can you kind of talk about the ongoing work that you're doing, your support of Cosmos and the ecosystem, and really for anyone listening who's not, obviously Cosmos has become one of the largest projects within crypto, but I think it is significantly less discussed relative to the presence it actually has in the market, given that in many cases it's behind the scenes. So can you kind of talk about why Cosmos, why it's important, why it's differentiated?
Totally. I mean, I think first of all, it's important to realize sort of what was the vision of Cosmos, and what was the world that the Cosmos, that we saw happening. And the vision here was really the idea that we will have many different blockchains. And the best way to secure those blockchains is through proof of stake. So that, we'll have many different blockchains. They each will have their own staking token, their own validator set, be responsible for their own security. But of course, when you have many different blockchains, you will still want to do things that, cross different blockchains. You have some assets that's being created on one blockchain, but you want to trade it on another blockchain, or you want to lend it on another blockchain, or maybe there's a DAO on one blockchain and it wants to hold the asset from another blockchain. So you have to have some kind of interoperability, some way for these blockchains to talk to each other. So this is really what Cosmos. And so when you look at like what has been built there, I mean, one is this Tendermint, which is basically this fundamental engine that allows a validator set to secure a blockchain, to produce the block that has security mechanisms, and so that's one thing. Another thing is this thing called Cosmos SDK. And Cosmos SDK, you can think of it a bit like WordPress for blockchains, where WordPress has made it like dramatically cheaper and easier to build a website, right? Because you can just take it and you have all of these plugins and it's open source, and you can just take that and you can modify it and you can launch something quickly. And Cosmos SDK is like that for blockchain, where you basically have all of these fundamental building blocks, and it's in this modularized way, so that you can just take them, maybe change some parameters, or maybe you develop some of your own extensions, and then you can launch a blockchain. So Cosmos SDK has really made it super easy and cheap to create your own blockchain. And it's really the best way. If you want to create a blockchain, the easiest, most efficient way is to use the Cosmos SDK. And it has definitely, lowered the cost of creating a blockchain by like 1,000x or something like that. And, you can developers can definitely, launch a blockchain within a few hours or something like that with the Cosmos SDK. And that has had a lot of success. If you look at the top 100, right, in like CoinMarketCap, there's probably like at least 10 that are run on the Cosmos SDK. Including things like, Binance Chain uses Tendermint. There's like Crypto.com is built on the Cosmos SDK. There's the Cosmos Hub itself. So there's a lot of different blockchains that are leveraging this technology. And then the third thing is IBC. And IBC is basically a protocol for how these blockchains can talk to each other. The analogy is often kind of like TCP/IP, where you have like these different computers and they have this messaging protocol and they can send messages and verify them. And that's kind of how IBC works, where the different blockchains can send packages to each other and verify them. And the simplest thing is just to send tokens from one chain to another chain. But, people are working now on many more like powerful things. So to send arbitrary data between blockchains and do like really cool use cases. So today, the Cosmos, one of the reasons I think also why Cosmos maybe hasn't gotten like that much attention is because the attention is like scattered among many different chains that are kind of building on this technology, but they have their own name, their own branding. They don't necessarily mention Cosmos, and you have in a way many different little ecosystem that using some of the same technology, some interoperability, and there is kind of a larger Cosmos community as well. And yeah, it's had a lot of success. I think today you have at least like 50, 60 blockchains that are live, that are, like meaningful with real teams and use cases and user experiences and people staking. And it's I would say of all of the crypto ecosystem, in the last year, it's probably the one that has grown the most and has had the most, traction and growth. So yeah, that's kind of the Cosmos ecosystem.
And is the Atom token needed for, like, if you are Binance Smart Chain or any of these other developers? I mean, I know, for example, there's a lot of talk of DYDX, obviously, moving over. And so what impact does that have on Atom? Like, do they actually need to stake a certain amount of Atom to spin up their own chain? So is there any, like, how does it actually interface with the token itself? Yeah,
that's a great question. Yeah. So in the Cosmos model, there is no, anyone can just take the Cosmos SDK, launch their own chain, have their own staking token, and you don't really need to do anything else, right? You don't need to buy any token. You don't need to lock up anything. You don't need to have atoms. You don't stake atoms. So there's really this aspect of sovereignty, very different from Polkadot, for example, right, where you have to tie in and you have to have dots and so the idea of the Cosmos Hub, which is the first blockchain, and the kind of blockchain that was launched by the team I was at back then, was that the Cosmos Hub would sort of provide services to these other blockchains, and could be used in that way. And this is it's kind of, I mean, the Cosmos Hub has some functionalities, but we still I think there's still the work happening on like what are these services. One thing where there is more like traction at the moment and a lot of development around it is a concept called interchain security. And that is actually this model of you can create a Cosmos blockchain if you don't want your own validator set and you don't want to have your own staking token, but you want to have the Cosmos Hub secure it. And this is more of a special case, right? Because really the Cosmos vision is that people have their own sovereign chains. But in some cases, people don't want that, or projects don't want that. Actually, one of the projects that is going to use interchain security is USDC. So they're going to issue USDC in Cosmos, and they are going to do this on this kind of special blockchain that's secured also with the Atom token. Because, Circle doesn't want to have a validator set. They don't want a staking token. They just want USDC to be on Cosmos, and they want it to be secure.
And how you mentioned there's 40 or 50 chains building on Cosmos. How decentralized are the validators on those different chains? I presume there's quite a big spectrum of decentralization.
Yeah, so with Tendermint, the validators have to communicate with each other. And if you have more validators, then it kind of slows down this communication a bit. So there is a bit of a generally the Cosmos chains have between 100 and 200 validators. That's sort of typical. And then of course the decentralization has a lot to do with the distribution of the voting power, right? Like how if you have a few validators that have 15%, it's not so decentralized, but if it's pretty well distributed, then it's more decentralized. I would say, how is it compared to, let's say, Ethereum? It's actually, and again, this is where it gets like complicated when you talk about decentralization, because there's different ways of looking at it. If you look at it in terms of what are the number of entities that are running Ethereum validators versus running Cosmos Hub validators, well, there's definitely more entities running Ethereum validators, like way more. However, if you look at how many entities would you need to kind of collude to halt the network, then I think actually Cosmos Hub would have a larger number of entities. And, you can kind of check it, right? So you have Binance, Coinbase, you have a few of those that are running Cosmos Hub validators, but they have like a relatively small, I can just check right now, you basically have the cumulative share to get to, 33% is 7. It's not huge, right? But if you look at Ethereum, you have some of the large, like Kraken and Coinbase, have really gigantic number of stake that's staked through them. And because in Cosmos, you really make it very easy for anybody to launch their own validator. I think much easier than to build like an Ethereum staking product that like an institution can use. So it depends how you look at it. And I think there's definitely debates around, what's more decentralized. Practically speaking, I would say there haven't really been issues around it being too centralized. But that's kind of the situation now.
Yeah, well, look, I think we could chat for an entire hour about Cosmos, but obviously you are now the co-founder and CEO of Chorus One and have been for over 4 years, I believe. So why don't we kind of move over and transition, though I might have to have you on again to teach us a little bit more about Cosmos. But why did you decide to move from a full-time role at Tendermint into building Chorus One? What was kind of the opportunity or problem or challenges that you saw in the space?
Yeah, so I was working at Tendermint, right? I started at the very start of 2017. I was there throughout 2017 as we were doing this fundraiser, and the team grew from when I joined. It was around 5 people to around 40 people through that year. Then I think there was I mean, one is the Tendermint ended up being kind of a little bit of a organizational chaos. So it was hard to get productive in there, and it ended up splitting up in many different organizations. And it was just, what was clear is that, proof of stake is coming, and it's going to be very important. And it's going to be the main way of securing blockchains because it's more efficient. It doesn't use energy. It doesn't use a lot of energy. It has better security properties. You can have better scalability, better speed, faster block times. You can have better interoperability. So there's all of these benefits of proof of stake. And it was very clear that this is coming, and that this is going to be a tremendously important step to bring the blockchain ecosystem to the next stage of its evolution, where it can really serve hundreds of millions or billions of people around the world, with all kinds of use cases and all kinds of different needs in different countries. And so, yeah, we just like saw that and wanted to work on that and wanted to, enable that. And that's how we kind of started to work on Chorus One. At the time, there was really nobody working on proof of stake infrastructure. Although at this around the same time as we started, you had other companies starting. You had Figment or P2P, or soon after, I would say Staked, and a few of those companies started. Stakefish all started around a similar time. And and since then it's become obviously a vibrant ecosystem. You've had a huge amount of people who are staking. A lot of proof of stake has become the main way that blockchains are being secured. Almost all of the new blockchains that are being launched are using proof of stake. You've had with Ethereum, the second largest blockchain, that switched from proof of work to proof of stake. We've had a lot of innovation around proof of stake as well, and it's kind of maturing as an industry. It's giving it a chance for people to participate in networks more actively, earn rewards, vote in governance. So it's really become a tremendously important part of how blockchains work, and it's exciting to be a part of that.
So you already very quickly, and without even me prompting, brought up a number of other staking providers in the space, right? And there are some more that have emerged over the last few years. So how can a staking company, and how does Chorus One specifically differentiate itself from its competitors, right? What are the services and products, right? Because I think from the outside looking in, I think a lot of people probably look at staking and think like, oh, maybe I want to diversify the number of providers that I'm going with to diversify some level of risk, though I believe staking is non-custodial anyways. But like, what is it that enables Chorus One to be different from its competitors, right? If I was a hedge fund and I would, let's say I had $100 million in an asset and I wanted to stake it, why would I choose Chorus One over somebody else?
Yeah, great question. So I would say you definitely have differences between, staking providers. So there are lots of different staking providers. But I think when it comes to, meeting some institutional standards, like there is, that's not a lot of staking providers who do that, and that has a lot to do. So you do certainly have risks, right? Like you could lose money, you could be slashed, or you do want to ensure that there's a high uptime. So I think you do want to have a staking provider that has, strong team, that has good processes around key management, security, maybe third-party audits, things like that. So I think that's one thing when it comes to just like high performance of infrastructure. Also the support of networks. So, to try support like many different networks, and to be also cutting edge when it comes to onboarding new networks. And then we also have a kind of institutional product in terms of the integration, so that you can stake. This is especially relevant with Ethereum, because in Ethereum, if you have like 10,000 ETH, then don't want to run one validator, but you need to basically, for every 32 ETH, you need to boot up a new validator. So then you need to have an API that you can kind of build against that, fulfills these requirements. So this is also something that we've built, and that allows good integration into different products. And so, yeah, those are some of the things. I would say one area where we're also pretty differentiated is around our research. So we have a large, a pretty significant research team, like super brilliant people, and have very much been at the cutting edge of a variety of different topics around proof of stake. And we work quite closely also with our customers to help them understand what are changes that are coming, how does that impact them, how do you have to think about that. And so this is also one way that I think can be interesting for customers to work together with.
And so one of the things that you mentioned was being kind of ahead of the curve on listing new chains and adding staking support for multiple chains. So how many chains do you guys support now? And what is your process? What actually provides an impetus or a spark for you guys to support a different chain? Is it a lot of the time, is it customers coming to you, or are you trying to, I know you also have a venture arm, so I presume that's part of the equation as to, you guys are probably seeing a lot of deal flow and new projects emerging, but kind of curious as to, one, how much support you have today, and two, how you really think about adding support for another chain and how much work that actually is, because I don't think people know that.
Yeah. So we support around 40 different chains right now. And in terms of how much work it is, it depends a lot. So it depends a lot on like the particular blockchain. So I talked
Right,
about Cosmos.
an EVM chain, it's significantly less difficult than supporting a totally unique.
Well, it depends because we are mostly on this sort of consensus level, right? And the EVM is on the kind of application smart contract level, right? So we care, I would say, especially around the of like how does the validation work? How do the keys work? How does the signing work? And this is actually also one aspect where Cosmos is very interesting because Cosmos is like standardized around how that works between the different chains. It makes the onboarding of a new Cosmos chain like dramatically easier. Sometimes when you have like some very different new chain, it could be, like 2 months of someone's time to like, or, it could be a substantial amount of time. But then when it's Cosmos, it could be like, within hours, potentially, you can like onboard a new chain if they don't do too many unusual things. So, so now in terms of how do we go about onboarding chains and how do we decide that, there's different things. There's definitely the question of like, okay, we may have clients who are, have a particular asset and they want this chain to be supported. So that's one thing. We are also with research, we're just researching, okay, what are interesting new proof of stake chains? We speak with the teams, we try to do like technical due diligence, understand the use case, the business case, understand like, do we think this has a good prospect or not? And then make decisions based on that to onboard networks. And, you mentioned ventures. So yeah, we do have a ventures arm where we invest in things. And especially what we've been investing in the most is proof of stake networks. So when we see interesting networks, right, that we think are really promising, along with onboarding them as a validator, we have often also invested in them. And this is also something where we often partner with our clients with, where we kind of help them with deal flow and share research about proof of stake chain, or like they're like, hey, what do you think of this project? Can you look at this? And, we can kind of share our perspective as someone, who's like very deeply into the infrastructure of these different chains and has a lot of experience in this. And so, and then we have this kind of process that
So from an investor perspective, right, you guys, it's all proprietary capital, I presume, right? It's all balance sheet that you're investing.
Yes.
Have you ever actually exited a position? What actually, like, given that you're just investing company balance sheet, right? What, when we could talk about it later in terms of how you think about investing and how you get into it. But I'm curious as to, as you're going and supporting these layer ones, and I'm sure there's other investments that you made. Have you ever actually exited one?
I mean, I don't think we have like fully exited anything, but of the things that we have invested, there's definitely a bunch that are like liquid. And I mean, for example, we were an investor in Lido, like in the seed round, and we were one of the initial kind of entities that one of the 5 validators that originally launched Lido. And so for example, Lido's been liquid for a while, and we still hold a lot of Lido, right? And most of the Lido we have, but now we sold some of it. So and I think that's we've done that with a few assets, but mostly we still I would say hold most of our portfolio, certainly.
Right. And so we'll get into investing. So I have a lot of questions there, but back to kind of the staking point. So what are the different ways an individual or fund can actually stake assets, and what are the benefits and drawbacks of those different ways?
Yeah, I would say it depends on the network as well, but probably there's like three typical ways that are. So one is delegation. So delegation basically means, let's say we have like a Chorus 1 validator running, and our customer can, for example, go in the interface in their custodian, and they have to just make a transaction that says, I'm delegating these tokens, or I'm staking these tokens. And then they have to choose a validator. And then basically that means that these tokens get sort of added to our stake and to our voting power. And it means we produce more blocks. And then the network directly issues more rewards. And then we take some commission, which is directly done on the network level, and the investor then accrues the reward. So this is like one way that it doesn't work in all the blockchains like that. For example, Ethereum doesn't work like that, but all of the Cosmos blockchains work like that, and most of the proof of stake blockchains have that capability. So I would say delegation is sort of the standard way of delegating. This is certainly the main way that retail investors delegate, but also for institutional investors. I would say very often this is the way, the easiest and simplest way to delegate. And we can also have potentially, some kind of agreements with some investors to provide additional services or around that. So this is one way. Another way is that we would run a white label validator. So that would basically be that you have a customer and they would need to have a more substantial amount of stake for this to make sense. But they say they want to have a validator that's running with their name and branding on it. And then we would basically create a validator just for them. They could also choose some of their own parameters. So and you could also have other people then maybe delegating to that validator, and they could maybe earn additional revenues from those delegations. And and so that can be another way. We are doing that with various different partners. One that's, for example, public is there's zero knowledge validator, which is I think the 5th largest on Cosmos right now. So they are really outstanding team. They do a lot of research around zero knowledge and governance and things like that. But when it comes to the operation of the infrastructure, they've kind of partnered with us to do that for them. And so, but it's, they can choose.
And I presume that another potential partner would be like an exchange or a prime broker or somebody in the space that wants basically services to clients.
Exactly. We also have custodian that we do this with. So yeah, it could be I think different kinds of institutions, this can be very interesting, especially also interesting because from a branding perspective, because a lot of people look at these lists of validators, and especially if you can, let's say, get into the top 20 or something like that, top 25, and then people will just see your brand, right? And I think that can be pretty powerful. So yeah, that's another one. And then then there can be, in a way, maybe let me come back to Ethereum in a second. Another way is liquid staking. So liquid staking basically means that you are putting your coins into some pool, and the this pool then stakes those coins. And when you put the coins into the pool, you're getting back another token. And this token then kind of accrues the staking rewards. There's, either it just increases in balance, so they just add more coins, or it could also be something that, you're getting like some token that's redeemable for, let's say, atoms as an example. You're staking atoms and you're getting like Q atoms. And then in the beginning, you put in one atom, you get one Q atom. But then after a year, you could redeem the Q atom and you get, 1.1 atom. So this is another way of staking. The advantage of it, there can be different advantages of this. One advantage of it is liquidity. So, well, I think the biggest advantage, maybe let's start with the biggest advantage is normally when you're staking, your capital is like locked up and you can't use it for other things. But let's say you want to use it because you want to use it as collateral to borrow against it. Then it doesn't really work in the normal staking model. But with liquid staking, because you're getting back another token, you could use that token then as collateral and borrow against it. So this is one advantage of this. Another one is that often when you're staking, if you want to stop staking, you have to go through some unbonding period. Basically, there's a delay and you have to wait for a while before you get your token back and you can transfer it. And this delay depends on the network. It could be 2 weeks or 3 weeks. Some networks it's longer and some it's shorter. It depends a lot. But with liquid staking, because you have this token that represents your staked assets, you could just transfer the token immediately and you don't have this kind of unbonding period.
But I presume you have risks of, is liquid staking always custodial? Because I remember a few years ago, Stakehound, I'm sure you remember, right? They were offering, I believe, liquid staking. They were offering like ST ETH, and then they lost the private keys to their wallet, and then no one could actually withdraw the underlying asset.
Yeah. This wasn't STETH. It was like, I don't know what they called their
whatever the staked asset was. I don't think ETH staking was live yet, but whatever it was.
No, it was ETH. It was ETH staking. Yeah. I'm familiar with the story a little bit. No, normally, basically, it's not custodial, right? Normally, you have a smart contract system that kind of manages the tokens. So I mentioned Lido before. Of course, Lido is by far the most successful liquid staking protocol. I think at the moment on Ethereum,
they also call it STETH as well, by the way.
They also call it STETH. Okay, yeah. So yeah. Because Lido's token is STETH, which is staked ETH. And right now around 30% of the ETH that's being staked is staked through Lido. So it's a huge percentage.
It's also the largest DeFi asset by TVL now. As of years ago. Yeah.
Exactly. And of course, maybe it's worth explaining also why liquid staking is really massive on Ethereum, much more than other proof of stake chains. And this has also a lot to do with the way that proof of stake was designed on Ethereum. Because in Ethereum, when you're staking, they haven't enabled withdrawals yet. So if you're staking in the normal way, you have to wait for withdrawals. Now withdrawals are coming up in March, I think is the expectation. So that's not so bad, 2 months or something. Of course, it could be longer. But, people started staking ETH like 2 years ago. And then basically, you have to wait 2 years before you have an ability to get your ETH back. It's pretty unattractive, right? So Lido was able to get around this issue. And because, in Ethereum, you have to have 32 ETH to build up a validator. What if you have less? So there's a whole bunch of these things that Lido was basically able to solve better by putting a smart contract in between. And then you have, in the Lido case, you have a governance token, LDO, which is used to vote on parameters and on other changes. And that's really kind of responsible for administrating the system. So it is also a decentralized, non-custodial system. Although, of course, there can also be custodial liquid staking system. I think Coinbase has launched one, right? There's CBETH, so the Coinbase ETH, which is a liquid staking token that Coinbase has launched, which I think is a custodial one.
It's got the longest name, isn't it? Coinbase wrap staked ETH or something like that. It's like
Yeah.
the longest name. So
um,
and so, we talked about some of the, I guess, risks associated with liquid staking. What are the risks associated with staking? I mean, you mentioned slashing. Can you kind of explain what slashing actually is and what that means? And, if somebody is non-custodial, is staking an asset in a non-custodial manner, what are the associated risks? You mentioned downtime and slashing, but can you kind of explain a little bit further what those risks actually mean?
yeah, so the fundamental, the direct staking related risk is, first of all, it is slashing would mean that the validator signs a transaction or signs different blocks that the network interprets as, if a lot of validators did this thing, the network would start running into problems. Or it could be, for example, be an attack. Let's say somebody wanted to attack Ethereum, then a validator could do this kind of thing. So the network has some rules to say, oh, if we see this kind of behavior, we're going to punish you. And then you could basically lose some of the ETH or some of the tokens that you're staking. Now, in practice, whenever this has happened a few times, right? That people got slashed. It wasn't because they were trying to attack Ethereum. It's because they made some mistake in their setup and they messed something up. So I think that's much more likely, right? But this can happen, and then you could lose some of the coins. In Ethereum, it can be quite a lot. I think it could be up to like everything, theoretically, or it could be a substantial percentage. In Cosmos, for example, it can be up to 5%. Other, Solana, for example, has talked about introducing slashing, but they don't have it right now. So like that possibility doesn't
And
exist.
so when somebody's slashed, the assets are just distributed to other stakers.
No, it depends. No, they can just be burned.
Okay.
Yeah, so they could just be like the protocol like wipes it out. So yeah, so you have slashing. Now I would say the following: proof of stake is now, live for 4 years, almost 3.5 years. And there has been, if you take like the amount of capital that's being staked and the amount that has been slashed in total, it is a very, very, very tiny percentage. So I think de facto, this risk is not a large risk. And I think especially if you're working with like, reputable, good staking provider, I think this is like, a very small risk. Another one is that, networks basically say, hey, we want to have a high uptime of validators. We want them to be like live, signing blocks all the time. And if they don't have that, validator goes down for a while, then they could basically decrease their rewards. So this isn't, you're not exactly losing money. I mean, you kind of are, because you're not making money that you could have earned otherwise. But so this is also one thing that that networks use to make sure that validators have a high uptime. I mean, the biggest risk in a way, which is of course a sort of obvious one, is that when you're staking, you're exposed to the price fluctuation of the staking asset. So if you're bullish on Cosmos, like Atoms, or on Sol, or on ETH, it makes a lot of sense to stake, because you're just getting like 5% or 10% or something in it, on top of the coins you already have. But of course, you are exposed to that asset price, and if the asset goes down by like 80%, then yeah, okay, you made 10% on the staking rewards, but like you're still down, a huge percentage.
Well, I presume a lot of staking then is locked venture capital money.
Yeah.
Right.
Yeah. I mean, I would say the vast majority is long-term investors in a particular network, holding these tokens, and they want to have, the additional yield, the additional appreciation from the staking asset.
So
yeah.
when somebody's staking assets, right, one of the natural questions is governance. And I know that's something that Chorus One has been very active in. So, how do you guys think about, right, when you're staking, right? I think that means that the vote has been, or you have the power over the vote theoretically if you wanted to, right? You could make a vote on behalf of the funds or the individuals that at stake their assets. But how do you actually go about that? How do you go about governance? Do you enable the clients that are staking with you to vote themselves? Are you making an aggregated vote? How does it actually work?
Yeah. So it again depends a lot on the network. So if you look at some networks, they don't have some on-chain governance mechanism. So Ethereum, for example, there's no on-chain governance. Nobody's voting on any proposal. So there's really no connection between the staking and governance system. Solana, same way. There's no on-chain governance. So like you're not really participating. In Cosmos, on the other hand, you do have on-chain governance, which means that people can make proposals. Anybody can kind of make a proposal, and then people who are staking or everyone who's staking can vote on these proposals with their tokens. And these proposals could be different things. They could be something like, hey, we want this changes to the protocol. We want to have a different roadmap. We want to change some parameters. Maybe we want to increase the inflation, decrease the inflation. Sometimes they have community pools. So they say like, hey, we want to fund this thing or invest in something. There's a lot of different stuff. And so basically all of the Cosmos networks work like that. And then when you have other networks, it depends a little bit, whether they have governance and how it works. But let me just explain on the Cosmos networks how it works, because I think that's the one where actually there's the most governance going on. In Cosmos, the way it works is that every staking account can vote directly on all of the proposals. And but if they don't vote, then their vote gets voted in the same way as their validator that they're staking with. So basically you have this ability. It's kind of like this, I think this is where no liquid democracy, or it's basically where anyone can vote directly, can vote on their own. But as long as the validators vote, for example, then all of these tokens vote in a certain way. So from that perspective, yeah, people can absolutely vote directly, and actually a lot of people are doing it. So to give an example, in Cosmos, you had recently this Atom 2.0 proposal, which was like a huge debate around it. And let me just load this briefly. I just wanted to see what percentage. But so you typically have 80,000 accounts or more that are voting in these votes. So like a lot, right? A really huge
account is a wallet address, or what is an
yeah. So it's a lot of participation, and we also vote, and we basically just do some research. We maybe have some internal debate. It depends a little bit on how complex the issue is. We cast a vote in some way. We also share a little bit about our rationale why we voted this way. And then as investors, right? If you're like an institutional investor holding some token, first of all, you don't have to vote, right? You can say, hey, other people vote. If you, for example, want votes to happen, you can vote directly yourself if you want to. Or you could say, I'm trusting sort of the validator that I'm staking with. I think they're going to do it in a good way. Or you could have a discussion with us about it. So there's kind of different ways of how it works. But I would say especially retail investors are like very engaged in this and often like discussing it. And I think institutional investors so far tend to not be that engaged in these on-chain governance discussions and votes. But the ability to do so is there. I guess one question is here whether the custodian that you're using is supporting the governance participation, right? And I think that depends on the particular custodian, because in the end, they have to sign a transaction, a specific transaction to vote, and maybe they have to support it in their user interface in some way. And of course, that's a little bit of like development and integration work. And that if that's not there, then that may be a reason why you can't participate. Although even then, as long as you're staking with a validator who votes, your vote, your coins, your tokens will still end up voting, even if you're not directly doing it yourself.
And so, moving on from governance, um, one of the things that I think you guys offer, and I think a few others might as well, is this idea of MEV boosted staking rewards. So when you're staking, basically using MEV to actually accrue additional yield beyond just what the staking reward provided by the network is. Can you speak a little bit as to how that works, and what are the additional types of returns that can be generated using MEV? And is it all custom MEV that you're using, or using something that's more open source?
Yeah. So basically, what MEV is that if you're the validator, you and at some point you are the one who's creating a block, and that means you're basically putting the transactions into the block, and others, as long as the transactions are valid, will approve your block. And now let's say there is an arbitrage opportunity where you have two different decentralized exchanges on this chain, and they're trading the same asset at a different price. Then somebody can go in and sell it high and buy it low, and they can make some money. And this is an obvious opportunity. Anybody could sort of like do it. So the question is then, who does that? And of course, as the validator, you are in a way in this privileged position that because you can decide what transactions go in the block, you can really do that in a way that nobody else can. So that's kind of MEV, and has of course been a huge area of research, innovation, work, and we have been very deeply involved in this as well. At the moment, where MEV is really the most the furthest ahead by a long margin is Ethereum. In Ethereum, you have a team called Flashbots that has created a special software that a validator can run. And in that software, you're basically auctioning off the ability to put transactions into the block. So that means that somebody else, not the validator, but some other party can go and look at all of these transactions. They see, oh, there's this arbitrage opportunity. I wanna be the one putting that transaction in, and then they're bidding for that. And if they're bidding the most, then they get to do it. And then this amount that they're paying for the bidding, this is basically extra reward that will go to the validator, and thus will go to the stakers. So we are running Flashbots on the Ethereum validators we are using. Flashbots, you then also have different relayers, which are basically people collecting these transactions, from different parties that are kind of like assessing that. So we've also tested a variety of different relayers, and trying to see like how do they compare in terms of returns. So at the moment, on Ethereum, you can definitely earn additional staking rewards or additional rewards from MEV. I mean, this changes quite a lot. I don't know exactly what at the moment the figure is, but I think it's maybe like something like a 10% increase in the staking rewards. And I think this is something that has been higher in the past, right? I think at some points in proof of work still, because this existed already in proof of work Flashbots, it was actually very high. So it will fluctuate a lot. When there's maybe a lot of market volatility, the revenues from that will go high. Whereas with staking, it's extremely stable. So that's the situation on Ethereum. On other blockchains, it's much earlier. And I would say the MEV returns, or the money generated from MEV right now is small to minimal. However, you do have different teams that are starting to build, software that can be used by validators. And, we've been pretty deeply involved in this, in, developing some things ourselves, in, running other things, super early on, giving feedback. For example, we're working very closely with a team called Skip, which is the leading MEV team in the Cosmos ecosystem. And they for example partner with Osmosis, which is this exchange in Cosmos, to like do MEV there, and they're also working for other chains. And so we are we're doing quite a lot of like data-driven research. We're doing some development. We're consulting with some of the MEV protocols in terms of how to approach it. We have a lot of conversations with our customers and with investors about, where's MEV going? How should I think about it? Like, what's the impact going to be? How could I position myself? So this is an area of huge interest for people. And because it is clear it's gonna be an area of it is an area of a very important area of huge significance, and there's going to be innovation and work around this for many years. And but I think in terms of at the moment today, in terms of actually boosting returns, I think it's really on Ethereum where that's happening. But I think within the next year, we can expect that this is going to start to happen on other chains as well, and it will be an opportunity to increase your returns.
So my last question on staking, and then I know we're running low on time, so maybe we'll go speed round for the next 5 minutes to just finish things up. But my last question I have on staking is, how do you as a staking provider hedge your risk? Right? Because naturally your revenue is predicated. You talked about it earlier. One of the biggest risks of staking is that the underlying asset drops by 90%, in which we've seen many instances, which presumably means that, as a staking provider, your revenue also drops quite significantly, right? So it is very, I wouldn't say transactional, but it's similar to an exchange where revenues are, just like we've seen with Coinbase, which is a public company where we can actually see, data, right, can be significantly impacted by asset prices. So how do you actually go about preparing for downturns and hedging your risk and building a team? Because for me, we're a SaaS revenue business, right? And I, for the most part, can try to predict my revenue going forward. But presumably for a staking provider, right, you kind of have to have some sort of thesis on where the market's going as well.
Yeah, that's a great point. So yeah, you're totally right that because our revenues are all in tokens, and if the tokens go down in, almost all in tokens, if the token asset price goes down by 80%, our revenues go down by 80% as well, right? So we are very exposed to the markets, which of course can be great when it's all going up, right? And I think from 2020 to 2021, revenues went up by 100x or something. But then of course it goes down on the other side as well when you have a bear market like this. So I mean, we have been, as a company, we've been pretty simple here in just liquidating for stable coins and fiat, sort of to ensure we have enough runway that we can fund our team and grow our team, and that we're a little bit less exposed. That being said, we have also spoken with various teams, and we have looked at some solutions that are doing more sophisticated things, right? Where you could basically say, let's say we could pre-sell future staking rewards, and sort of lock in the price. So this is something that we've evaluated a few solutions, and there are some companies that have been working on products like that. Unfortunately, those are all kind of came in the last months, and they're very immature, I think, and novel. But I definitely think in the next market cycle, this ability is going to be there much more. And I think that could also start being very interesting for, not just for a staking provider, but for a normal institutional investor as well. We have actually been assessing the idea of having some kind of hedged stake ETH product, where you would basically put some money in, buy ETH, stake the ETH, and then with the staking rewards, buy some downside protection on the principal value, that you could basically have some kind of risk-free return. So we've been assessing that. Actually, if people are really interested in this, we've been sort of exploring how could you create a product like that. They should feel free to reach out. And I think products like this will be able to be one can create products like this certainly in the next years, in the next market cycle. And I think that will give some very interesting opportunities for having really risk minimized returns through staking.
So a couple final questions, and let's go through them, pretty quick. So, we briefly touched on Chorus One, ventures arm. So why was that created? And is that purely strategic, or are you guys financial investors as well? And, what are you kind of looking for in opportunities?
Yeah, I mean, we work very closely with a lot of different crypto projects, and just the ability to invest in high quality projects is great. And it allows us to partner with them more closely, learn more about them. And of course, definitely we want to make investment returns as well. And so that's kind of, and when we, run infrastructure for projects, it just makes a lot of sense that we have some exposure to the underlying asset as well. So that's why we decided to do this.
So, this is the Fundamental Value Podcast. So one question that we ask all of our guests is around fundamentals. So how do you define fundamentals for digital assets? And how do you really think about, what makes something a kind of a sound investment opportunity in the long run and something that should accrue value?
Yeah, I mean, I think in the long run, it's really around what is the service that this chain provides, or this crypto thing provides, and how much are people willing to pay for that. And then you could really do some kind of discounted cash flow analysis, and I think that is the right way to do it for at least a lot of the things. Of course, there are other types of assets, I don't know, Zcash, Monero, Bitcoin type thing, where maybe they're like monetary asset that you can't value that way. But I think for a lot of things, it really is around what are the kind of protocol revenues that can be created. And I think you have this side note token terminal that provides some of these metrics in a nice way. And I think that's a good way of looking at, like, what are the values? Is it a good price or not?
Of course, revenues are very different from fees actually accruing to the token holders, though, right? I mean, there are plenty of tokens that have significant revenue, like Uniswap, where currently, the token holders aren't yet accruing any value from the underlying assets. So, how do you?
Okay, yeah, you do have. Yeah, you have to look a little bit at the nuance, right? I guess some things you have to consider. Okay, in the Uniswap case, of course, if it all goes to the liquidity providers, not to uni holders, then yeah, that's not really revenues that in the future you could just divert to uni holders, because then the liquidity would go somewhere else. So like, yeah, that's definitely a complexity you have to take into account.
And of course, it's earliest stage, like as a venture investor, right? You don't really know. I mean, you guys are investing early, like seed stage. Correct me if I'm wrong. In earlier stage, you guys don't really know what the revenue that will be accrued in the future is, right? And so, do you spend a lot of time looking at the actual token economic model, or do you more look at, hey, do I believe this thing is going to be widely adopted?
Yeah, I would say more the latter, right? More like, do we think this use case makes sense? Is the team strong? The technology makes strong? Like, is there? I mean, I think you can still look at like the underlying. Is there like a sound business model? I mean, let's take Lido as an example. In the Lido case, there is a very clear business model, right? Because there's ETH that's being staked through Lido. ETH's generating rewards. Of the rewards, 10%, 90% go to the stakers, 10% go to the DAO. Of those 10%, half of them go to node operators like Course One and some others, and the other half go into this DAO treasury. Right. So in essence, you can think of this 5% that goes into the DAO treasury. That's kind of like the revenues of the DAO. And you have like and you can look at LDO, and you can sort of look at like, okay, what is the market cap of LDO relative to that revenue stream going in there? And of course, there's other expenses they have, because there's a team they need to pay. And
you also presumably have to be concerned about, the ability to unstake ETH at some later date as well, and how that impacts future revenue.
Totally. Yeah, exactly. And of course, there's all kinds of risk, right? Maybe in the future, some other protocol will become much bigger. And, there is a lot of uncertainty for sure. But I do think, if you look at where we are today, at least you can do some of these evaluations, and you can start to approach it for like a lot of protocols, which is like far from where we were like a few years ago, right? In like 2018, there was really nothing that you could value in this way.
And so I have infinitely more questions, but I'll leave you with one final question, which is, we're recording on Jan 4. It might take a few days or weeks for this to come out, but what is the most critical thing to look out for in crypto in 2023? What are you watching for? It can be a positive impetus. It can be a negative impetus for the market.
I mean, we are really, I guess there's different things, but like, we are just focused on, doing what we're doing better, working with institutional clients to help them get on board onto staking, integrating with them, providing better, improving our products to make sure they serve their needs better, onboarding new chains, we're doing all of those things. And it's kind of like regardless of the market. I think when you look at the market, uh, of course, the market is tremendously important. What's going to happen there? And I do think that the macroeconomic environment is just like super important there and like a huge factor. So, what's going to happen with inflation and with interest rates? I would guess that the bullish scenario is something that the economy slows down, inflation goes down, they're going to kind of loosen the monetary things again. Maybe the Ukraine war gets resolved and then the markets are going to do better again. I would say that's sort of like the hopeful scenario that would lead to recovery. I guess the other thing to look out for is what are we seeing in terms of actual adoption? Like use cases that are just like good and normal people start using it more. And I think we still have not seen that, right? To the point where, I mean, we saw the bid with NFTs, but
Well, one question I wanted to ask you earlier is, you spoke so much about making it easy for devs to build on Cosmos, but how do we make it easy for consumers to onboard, right? So I totally agree with you on that point, right? Is on finding that use case and making it easy for people to actually interact with it.
Yeah, absolutely.
And so, I really appreciate the time. This is awesome. I have so many other questions I could ask, but I'll let people reach out themselves and ask questions. So where can people find out more about Chorus One? You mentioned your research a bunch of times, so I'd love to point people to your research specifically. Where can people kind of follow you and find that information?
Yeah, so they should just go to our website. So that's chorus.one. I'm sure you can put a link in there. So you can find a lot of things there. You can find we produce also a quarterly research report around staking with a lot of like data and research reports. So you could check that out, or you can find a lot of things on our blog. If you're interested in terms of, staking with us, or like, want some sort of support for like, institutional or like, then you can also reach out there through the contact form, and we'll get in touch and we can set up a call and try to help you navigate the exciting world of staking.
Awesome. Well, thank you, Brian.